We have a new free book for Human Action Podcast listeners, Dr. Guido Holzman's How Inflation Destroys Civilization. Learn how inflation isn't only making us poorer, it's harming our culture, mental well-being, and the moral foundations of civilization itself. Get your free copy today at Mises.org/HAPodFree. This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Brent, welcome to the Human Action Podcast.
Thank you for having me. I've been looking forward to this.
Yeah, me too. So, for those who don't know you, because in these episodes we don't separately pre-record an introduction, can you just explain, what Santiago Capital is and your position and what you guys do?
Yeah, sure. So Santiago Capital is a wealth management firm. I've been in this business for about 25 years, started in the late 90s with a firm called DLJ. That was purchased by Credit Suisse, so I was with Credit Suisse for 10 years. Left there shortly after the global financial crisis to work for an independent registered investment advisor, and along the way set up my own registered investment advisor. So I've been in kind of the wealth management business for the last couple of decades, and I kind of focus on the big picture, a lot of macro related themes, and that's kind of how we met then through the debate of the dollar a few weeks ago.
Okay, yeah. Well, can you speak to what's that map over your shoulder? Because I know that's relevant.
Oh, sure. So my company's called Santiago Capital, and the name comes from the lead character in my two favorite books is named Santiago, and then this is a map of the Camino de Santiago, which is a ancient pilgrimage route across the north part of Spain that I hiked back shortly before I started my career on Wall Street in 1999. So it's kind of become a big part of my life, I guess. Okay,
great. So yes, as Brent alluded to, he and I recently participated. We were on opposite sides of the debate. And Zero Hedge hosted it. It was Michael Every and Brent were arguing that the dollar would still be the world's reserve currency, by 2030, and Jim Rickards and I took the opposite side to make a case that no, it will not be. And there was a particular exchange in that debate where, and when we get to the point here in the discussion, folks, we'll play the clip. And I asked Brent to come back on just to have a more careful going back and forth, because I think it's a central point of the dispute is the role that the euro dollar plays in all this. But before we get into all that stuff, Brent, you are, among other things, known for the dollar milkshake theory. Can you explain what that is? And the point, I assume, is not that you think that the U.S. dollar is so strong that at one point you'll be able to get milkshakes for $1 again. That's not what it's...
Well, that'd be nice, wouldn't it? Okay, so because I've been in this wealth management business for a number of years, I've always worked with other individuals. I don't manage institutional capital. I don't run a big endowment fund. And so the people on the other side of the table for me are typically very smart, but they're individuals who are not necessarily versed in financial lingo or monetary policy. And so I've always had to try to figure out simple ways to explain fairly complex topics, whether it's related to geopolitics or monetary policy or market dynamics. And so I came up with the dollar milkshake theory as a framework for explaining how I thought a sovereign debt and currency crisis would play out. And I started talking about this in 2018. So I've been thinking that we would have a crisis related to debt for several years now. I'm somebody who believes that debt has consequences. And I think, so I think when those consequences start to be felt, that the dollar milkshake would help explain how that would play out. And I'll tell you what those dynamics are here in a second. But I think what I said back in 2018 was that in the years ahead, we would have a situation where the dollar would rise, where gold would rise, and U.S. equities would rise. And we would have a situation where we would have a currency crisis and a sovereign debt crisis. Now, we sort of had a currency crisis a couple of years ago. Not really. It started to get into the early stages of one. We haven't had a sovereign debt crisis, so to speak. But really what I think happens And what has happened every other time, over the last several decades, is whenever a crisis happens, the global monetary authorities, the governments, however you want to define the powers that be, have responded by increasing the monetary base or doing bailouts, doing QE, fiscal stimulus. Basically they provide additional liquidity to the system. And my thesis is that if and when that happens again, they will react in the same way. But when a crisis happens, because the world is on a U.S. dollar standard, it's no longer on a gold standard, it's on a U.S. dollar standard, I think the U.S. dollar will be seen as the relative safe haven. Even though the dollar might be losing value in overall purchasing terms, I think it will rise versus foreign currencies. And the U.S. dollar rising versus foreign currencies has dramatic impact on asset prices all over the world. And so what I think will happen is that the U.S. will be seen as the relative safe harbor in the storm. And the milkshake comes from a movie called There Will Be Blood. And in this movie, Daniel Day-Lewis played this evil, ruthless oil executive, and he was negotiating a piece of land with his neighbor. And the neighbor was saying, if you buy the land, you can have all the oil underneath it. And Daniel Day-Lewis said, well, I don't really need to buy your land. All I have to do is stick a straw down on my side of the fence, and it'll reach underneath the fence, and it'll drink your oil. And he says, I'll drink your milkshake. And I think that is largely what has happened since COVID, and I think that would be largely what would happen if we do have another crisis. I think the rest of the world and the U.S. will respond by, printing more money, doing bailouts, but I think that will largely get sucked up into the United States and into the dollar for many reasons. Some of them deserved, some of them probably not deserved. But that's the way I see it playing out. And as a result, I think U.S. assets will rise versus other assets around the world. So that's the dollar milkshake. And it kind of becomes this vicious cycle where higher dollar begets higher dollar. A lack of liquidity overseas becomes a perpetual negative cycle, and we get kind of this blow off acceleration to the upside. And then I think everything eventually gets reset.
Okay, great. So even within that framework, the one part I don't fully follow your logic is, so I get how, if there's a global crisis, people run to safety. We saw that in 2008. Like, for example, Peter Schiff was pretty good, not pretty good, he was very good in like 2005, 2006, 2007. There's YouTube compilations of him calling, what's going to happen with the real estate markets. But he also was short, my understanding is he was short the dollar going into the 2008 crisis because he understandably thought, well, gee, in a world where the Federal Reserve has grossly mismanaged things and caused all this monetary inflation that, spawned all these problems, surely when the chickens come home to roost, the dollar's going to fall. And yet that isn't what happened. And I think, you could say, well, yeah, because the thing that he wasn't building into the forecast was everyone around the world panicking and rushing to treasuries. So I get that. But even there, the stock market, U.S. stock market certainly took a beating, at least temporarily.
Yeah.
And so what am I missing? Like, I understand gold going up and the dollar strengthening against other currencies, but why would the U.S. stock market go up?
Well, and this is probably the most debated part of the thesis.
Okay.
And listen, I fully admit I could be wrong. But this is kind of how I see it. Is I think what's going to happen is if we have a sovereign debt crisis, that will be the repudiation of countries' treasuries, not just U.S. treasuries, but treasuries all over the world. And in other words, we get into a situation where global interest rates are rising. Some of them for inflationary reasons, some of them for counterparty reasons. And as money starts to leave those sovereign bonds, that would force other currencies or the governments to have to print more of their currencies or provide more stimulus, provide more, QE, however you want to define it. But I think what happens is even that potentially is happening in the United States as well. In other words, interest rates may be rising in the United States as well. But in that environment, as money is leaving bonds, it has to go somewhere. And as people sell bonds, global bonds all over the world, and they look for another place to go, I think gold would probably be a beneficiary of that. Perhaps Bitcoin would be a beneficiary of that, but I think large cap U.S. equities would be a beneficiary of it as well. So I think in some ways, U.S. blue chip equities would become the new treasuries.
Okay, great. If you don't want to answer this, that's fine. But
That's fine.
Like in terms of the three prongs of what the dollar milkshake theory is, at least in its original form, are you saying you're more confident that in a global sovereign debt crisis, the U.S. dollar vis-a-vis other fiat currencies and the U.S. dollar, and gold versus all those currencies and even the U.S. dollar would rise, but you're not as confident that the stock market, is that it?
So the way I think it happens is I think initially equities do fall.
Okay.
But I think just like in 2008 they fell, and just like in 2020 they fell. But I think the response to that would be very similar to what happened after QE and what happened after COVID and what happened after 2008 is that all that stimulus that gets injected back into the markets pushes U.S. equities higher. Except this time, I think it could be that U.S. equities arise alongside not only U.S. interest rates, but interest rates around the world.
Okay, so just to be clear, it's not so much the crisis per se that causes the U.S. stock market to bounce. It's the response to the original crisis that then fuels it.
That's right. But what has typically happened is in that response, the dollar has fallen. And I'm not sure that will happen this time. I think we will get into a situation where U.S. equities are rising along with the DXY going higher and along with gold rising along with it. So think of the dollar rising versus all other currencies, U.S. equities rising versus all other global stock markets, and gold rising versus all other currencies. It's kind of a relative argument. I think the U.S. on a relative basis will outperform the rest of the world in a sovereign debt crisis. There's no way I will get this 100% right. I know for sure I won't get it 100%. That's the only thing I'm sure of, is that I won't be totally right. But I think if I get it largely right or even a little bit right, which I think I have so far, it has helped me kind of navigate the craziness of the markets.
Human Action Podcast listeners, you can enter in to win free attendance to an upcoming Mises Institute event. 2024 marks the 75th anniversary of Mises's great economic treatise, Human Action. And in honor of this occasion, the Mises Institute is holding a special conference on May 16th through the 18th. Scholars from around the world will be there, including Guido Holzman, Bob Murphy, Joe Salerno, Tom DiLorenzo, and more. Visit Mises.org/HA-Raffle to enter into a drawing for free admission to the event. If you're a student, scholarships are also available at Mises.org/HA24. Now back to the action.
Okay, great. So then switching now to the zero hedge debate, and obviously, folks, well, I'll put links to all this stuff as well as Brent. I know you've got like a highly viewed YouTube video of you laying out the dollar milkshake thing and going through with was it the Highlander? Is that the other movie reference you make?
Yeah.
So that's a good one. People can.
Well, do you want me to let me explain that real since you brought it. So I've used the Highlander reference as a way to explain the theory, because I've had many people tell me that in a sovereign debt crisis or in some kind of a global crisis, gold will do very well. And my point has always been, I think gold will do very well. I think gold will ultimately win the day. It will be the last man standing. But I think before that happens, the dollar will crush every other currency. And so I've used the Highlander reference, which is this movie from the 80s about these immortals where they go around the world fighting each other. And I've used the Kurgan. The Kurgan was the bad guy. And so I've referenced him as the dollar. And then McLeod was the good guy. I've referenced him as gold. And in the final showdown, I think McLeod will beat the Kurgan. I think gold will beat the dollar. But leading up to that very end of the movie, the Kurgan ran around cutting off all the other immortals' heads. And so I think that's largely what will happen here. I think the dollar will crush every other fiat currency. But in the ultimate showdown with gold, I would expect gold to win.
Okay, great. And actually, I think I mentioned this to you when we were down there in Florida, Brent, that when someone originally sent me and said, hey, what do you think of this? And it was, your presentation of the dollar milkshake theory, I wrote back something like, I'm not saying he's right, but that's entirely plausible. I have no problem with what this guy laid. So you get in terms of a scenario of how the events unfold. In fact, I've even said a while ago, if you make me prognosticate that I thought, okay, there'd be another crisis eventually. So up in the late 90s, early 2000s, the .com tech stocks crashed. Okay, and then in the 2008 crisis, household name investment banks went under. And then I thought, okay, maybe the next crisis, you're going to see countries going under.
Yeah.
And then, clearly the Fed's going to be doing swaps with the ECB or whatever and bailing out the euro, whatever. And so I think the Fed would, and then I thought, yes, then finally the final battle would be then even, once the Fed has bailed out the whole world, then the last shoe to drop would be the dollar crashing. So that sounds like, sort of like your Highlander thing. So okay.
That's right. That's right.
Okay. So, so I guess as far as the zero hedge stuff, so I think an important distinction to be made, whether in practice it matters or not, is I am not so much like what I was doing at that zero hedge debate was not saying that I thought the dollar was going to be lower versus the yen or the euro 10 years from now. I think it's possible it does strengthen against them even amidst it still shedding, its share of its role in global commerce.
Yep.
And so, now that I'm bringing up that distinction, are you, is your thesis? Are you more sure that the dollar's going to strengthen against the yen and the euro 5-10 years from, compared to today versus 5-10 years, or is it? So you get what I'm asking?
Yeah. So the timing, of course, is the hardest part, right?
Mm-hmm.
I think everybody would agree that the timing is the hardest part. The main point that I have wanted to get across with this thesis is that regardless of the timing, if and when we get into a situation where the dollar is no longer the global reserve currency, the process by which the dollar is no longer the global reserve currency will see the dollar go much higher before it goes ultimately much lower and it's no longer the global reserve currency. And it could be that going higher is what causes it to no longer be the world reserve currency because, again, the powers that be would probably have to come in and do some kind of new Plaza Accord or some kind of a system reset or a redenomination of everything. But I think it's the crisis of the dollar going higher, which is what would then perpetuate or would what then eventuate the dollar no longer being the global reserve currency. But I do not think we can transition from the dollar being the global reserve currency to the dollar not being the global reserve currency without great volatility along the way. And I think in that great volatility, that's what sees the dollar higher rather than lower. So I do not believe that we could have a situation where the dollar just gets worth less and less and less and less and less over let's call it a 20-year period to where then it's no longer the global reserve currency. I don't rule it out. It's not impossible, but I think that is about the least likely event in my opinion.
Okay, so that's interesting. So it sounds like not only, are you comfortable with that distinction, but you're actually building that in. You're saying, yeah, even along the way to achieve what Jim Rickards and I were saying is the ultimate end game here, where we're going to get to a point where the dollar is no longer the world's reserve currency. Your point is the likely way to achieve that is going to be involve the dollar strengthening.
Correct.
So maybe I misunderstood the rhetorical point you were making. So just for the folks at home, Brent, here, why don't we pause? I'll play this short clip. Okay. It's the one, Brent, from that I sent you ahead of time. That I included in the previous episode of the Human Action Podcast, where you're
I watched it.
Cross-examining, if that's the word, Jim. So here, folks, we'll go ahead and play a clip.
How does the rest of the world that owes 30 trillion, 50 trillion, depending on how you calculate on balance sheet or off balance sheet numbers, how do they lose $50 trillion in assets and not suffer?
I never said they lose 50 trillion.
I'm saying they will, because they owe $50 trillion to each other. Okay. That's the euro dollar debt.
Okay.
They owe it to each other. They don't owe it to the United States.
Right.
So if that loses value, they're losing value in their assets. How does that not punish them?
Punish whom?
The holders of those bonds or those loans.
It punishes the whole world. That's the
Exactly.
second Great
And so,
Depression.
and in that scenario, which direction does the dollar go versus other currencies?
Well, at that point, you are talking about something closer to a dollar collapse. But right,
Before it collapses, which way does it go?
right now, the dollar is getting stronger.
Which way will it go if those loans collapse and they default on them? It goes higher, Jim. The dollar goes higher. In a dollar squeeze, in a credit contraction, the dollar goes higher.
Well, you're not distinguishing between nominal and real terms. The dollar could be higher in real terms.
Versus other currencies,
Well,
which
you
way
get
does it
into a
go?
deflationary-
Versus other currencies, which way does it go?
Well, they're all in the same boat.
Which way? No.
No, there's no world. No, answer the question. There's no world where the dollar is crashing and everyone says, "Hey, get me some euros." They're all going to crash together.
Which way does the dollar go versus the euro and the yen and the yuan in the scenario that
Well,
I
why don't you
painted?
ask the real question? Which way does the dollar go relative to gold? This is the
We'll
world
get to
of
that. We'll
no,
get
well,
to
I'll
that.
get to it right now. This is the world of $5,000 gold. In other words, it's impossible for every currency to devalue against every other currency at the same time. That's the math.
Which is exactly why the
that's
dollar
a
will rise.
mathematical
Which is exactly why the dollar
That's a
will
mathematical
rise.
impossibility.
Okay, so now, Brent, in light of that, just so the folks at home saw the context, I thought the point, and so maybe I just misunderstood. I thought you were trying to argue that Bob and Jim, no, you guys aren't thinking this through. Let's suppose investors around the world did start getting worried about the U.S. debt level. They see the CBO report and whatever, and so they start trying to get out of get out of treasuries to be more accurate. And then that starts to make the yield on treasuries drifting upward, but then that causes problems given how much euro dollar debt there is. And then that causes a crisis. The dollar strengthens. And so the dollar can't forfeit its status as world reserve currency, because even in the process that you guys are talking about, there's forces that would push it back and put the dollar back up on top. That's what I thought you were saying. Is that?
That is my belief. I do not. So because we live in a system where it's a debt-based monetary system. So the money that exists, 99% of it has been loaned into existence. So in that process and not only is there huge dollar debts inside the United States, there's even more dollar debt outside the United States that is owed by non-U.S. entities, and they owe that to other non-U.S. entities. So it's not that they owe that all to the United States. And so in a debt-based monetary system, if you're in a dollar debt-based monetary system, which is what we have, de-dollarization is the same thing as deleveraging. And when you deleverage, that's typically a painful process. And when you deleverage, that typically sees the underlying currency rise in value. And that is just real. That's what a credit contraction is. Whenever you see a recession or some kind of a crisis, it's because money is no longer circulating and credit is no longer being extended. And everybody is scrambling for the few dollars that still exist. And when a loan gets defaulted on, that means that the demand for that amount of money is now gone. But it also means that supply has collapsed because, the system is loaned into existence off of the collateral. So as credit contracts, and asset prices start to fall, the base off of which new loans are made starts to contract. And that's what happened in 2008. That's what happened in 2000. It's what happened in 2008, and it's what happened in 2020 with COVID. Is that money stopped circulating, loans started to get, not just loans, but overnight repo and money market funds started to fail, and because you have a scramble for collateral, because there's, again, the monetary base is only about 5 trillion. And everything else, all the other monetary aggregates are loaned into existence. And so if the money that's loaned into existence no longer circulates, all of that demand, this is where it starts to get a little confusing. I'm gonna pause here because I want to make sure people get this. a lot of times when you see monetary aggregates, you'll see the monetary base, then you'll see like M1, M2, M3, and then they'll start using like securitized debt, et cetera, et cetera. The monetary base is the reserves at the Fed and currency and coins in circulation. Excuse me. That is the only money that actually, quote unquote, exists. Everything else is loaned into existence off of that money as the base. So while if you look at M2, that is often characterized as money supply, and it is, but it's also demand. It's demand on the monetary base. So in a situation where that M2 is no longer circulating, people are no longer going on vacation, they're no longer buying that refrigerator, they're no longer putting gas in their car, and you start to have a contraction, that monetary base, that M2 is now scrambling to get their hands on the monetary base. That's what a credit contraction is. That's a bank run, right? That's when everybody shows up to pull their money out of the bank on the same day, but the bank doesn't have all the money in there because they've made loans in excess of the reserves, or they've made loans in excess of the base money. And so what we had in 2000, what we had in 2008, and what we had in 2020 was a global bank run on the US dollar. And as people are scrambling for dollars, they're selling everything they can, not what they want to, they're selling everything that they can to get their hands on dollar liquidity. And I think that's what would happen, and that's the point I was trying to get across to Jim. If the rest of the world starts defaulting on their dollar debts, then assets are going to start disappearing as well. And then you're going to get back to this bank run scenario where everybody starts selling everything just to get the dollars, and you're going to see the dollar rise very dramatically, not just versus other currencies, but probably against different assets as well.
Okay, I think I followed that logic. So here, let me just take a moment, Brent, and spell out something and have you react to it. So I think the biggest, or the way to isolate the difference in perspectives that we're having on this, I think I largely agree with what you said. And so, yeah, if for other reasons people were scrambling, they wanted to get their hands on, base money, they were panicked for certain reasons, a rush to, more actual like legal tender U.S. money, not just, well, that commercial bank says they owe me the money, right, basically, but no, I want to have $100 bills or what have you. I agree with everything you're just saying there. And yes, if for some reason right now, some firm in Germany owes $1 million US to some pension fund in Germany, and that German firm is having difficulty coming up with the USD, maybe because their business is running euros and the euro falls against the dollar. So now it's tough for them to come up with those USD that contractually they owe. So they default, and then it causes a cascade effect. Now that pension fund thought we had $1 million USD, and now that, take a haircut, what have you, it cascades through the system. I get all that. The more modest point I'm making, though, is I think I've seen, like, what you were doing with Jim in that debate, and then I know George Gammon's written up some things, and on Twitter he has a lot of thought experiments, and I'll link folks if I can. George has the mother of all blog posts on this. I don't know if it's going to be live by the time. I think you've seen it too, right, Brent?
You sent it to me last night.
Yeah, same here. Okay, so yeah, hopefully folks, by the time this episode posts, it'll be available for public consumption, and we can put it up there. So my big picture issue is that may happen, in practice in the real world. I'm not denying that, but conceptually, I think we can easily imagine a scenario where if everything else were fine, and the one like sort of force that we wanted to study the impact of as economists, modeling this in a thought experiment, is just what if people around the world, foreigners, decided they wanted to reduce their exposure to US dollar assets. I don't see why that would cause defaults. So it's not like the start of the analysis is not, okay, we have an original equilibrium, and now suppose people start defaulting on their dollar debts. It's the other way around, that people who right now have dollar assets, foreigners, decide, you know what, I want to diversify out of it. Right now we have 13% of our portfolio in treasuries. I want to bring that down to 5% over the next couple of years. And I don't see why that process would involve defaults at all. I think the dollar would fall against other currencies in that scenario.
So I hear what you're saying here, and I actually listened to your episode, whether it was yesterday or a week ago, and so I know I understand the point you're making. So let me try to address it this way. If it's done a little bit at a time, and it's done by a minority of the participants in the world, then that could absolutely happen. And so what we could have is we could have a situation where the dollar DXY goes to, it's at like 103 now, let's say it goes to 95 over the next 2 or 3 years, and the euro and the yen rise versus the dollar a little bit as a result of that. And, monetary authorities around the world, they whenever things start to, get out of control, they put some new facility in place, and the global economy just kind of lurches along or just kind of grinds along for the next 2 or 3 years. I think what you're describing can happen. But what I don't think can happen is on a systematic wide basis for the rest of the world to stop using dollars and transition to a new currency without what I'm describing happening. And here's why. Because if 1 or 2 people do it, it's no big deal, as long as in the aggregate, more people are not doing it. So what I mean by that is you may have heard this term, or your listeners may have heard this term, you can't taper a Ponzi, right? You can't taper a Ponzi system because it's predicated on growth. Well, in a debt-based monetary system, because it has interest attached to it, because money is loaned into existence, because loans have interest attached to it, there is never, ever enough money to pay off all the debt. There will always be more debt than there is money. And so the system has to grow. It has to expand. Now, it can contract for a short period of time, a couple months, maybe even a year. But the reason that you always see central bankers come in and put new collateral in the system, or do bailouts, or do stimulus, or do QE, whatever it is, the reason they do that is because the system cannot go into a reverse gear for a sustained period of time without eventually hitting what we were talking about before about a credit contraction. It can happen for short periods of time, and it can, one group can be de-dollarizing or deleveraging while another group is increasing leverage. But overall, in the system itself, the system must grow. It's an exponential system. And and anything that grows and anything that always grows will eventually, have that exponential curve where it just goes straight up. And then that's when crashes happen, because exponential curves never always continue going up. They always eventually roll over, and then you get this big disaster. So, but I think the example you were using in the episode that I watched previous to this, and then what I think you were just saying now, isn't it possible that, let's say that Europe as a whole starts to de-dollarize over the next 2 or 3 years, and they make some progress doing that. If the rest of the world does that as well, then I think it will lead to what I was describing. And here's the reason why, is because if you are using less dollars, then there is going to be less demand for dollars. If there's less demand for dollars, then the Treasury is probably going to have higher interest rates to attract the people to buy the dollars, right? And all this euro dollar debt already exists. So even if going forward, entities were to no longer use dollars going forward, all of that dollar debt that they've used previously still exists. It doesn't just go away. And now if dollars are used less going forward, that means there will be less dollars circulating. If there are less dollars circulating and interest rates are now higher in order to attract the less dollars, now the rest of the world has all this euro dollar debt that they have to pay off. There's fewer dollars to access to get it, and the interest rate is making them even harder to get. So that then, I think, will lead to the defaults that I'm talking about. So I think what you're describing can happen for a few months, for a few years, but I do not think I don't think what you're describing can successfully transition from the dollar being the global reserve currency to a different currency being the global reserve currency. I think in that process, while what you're describing might last for a few months or a few years, to ultimately get to the de-dollarized area, I think would have to go through the volatility that I'm describing.
Okay, so I apologize, folks. It's what Brent and I are quibbling about here. I think is critical to the debate. So
It
that's
is.
why I want
It really is. It really
I don't
is.
want to go over this.
This is the heart of it.
Yeah,
This is the heart of
and
it.
so I'm going to take some time. I might try like a couple different approaches here. The point here is not to emerge and one of us is going to be the victor and one's not.
No.
I just want to make sure we grapple with this because I think there's a subtle conflation that might be going. Again, it doesn't mean you're wrong. It just means I think there's things we've got to tease out here. So if U.S. interest rates rise because the Fed is tightening, then I totally get what you're talking about, and then that causes a ripple effect through the system. It's harder. The people that owe dollars, it's more expensive for them to get their hands on it, and so they could cause a wave of defaults, and it's a vicious downward cycle. I get that, but I think if the reason for the rise in U.S. interest rates is because the world as a whole is trying to reduce its holdings of treasuries, and so the equilibrium price has to rise to get somebody to be willing to hold it, then I think it's easier to pay it off. So let me start with this analogy. First, Brent, tell me, do you agree in the analogy I'm going to give you that my logic works, and then it's just you disagree with applying it to the euro dollar system, or if you just think, no, even in my analogy I'm wrong. So the analogy is, let's think about cigarettes, okay? And so imagine we're just focused on the U.S. right now, and maybe it's a town somewhere where people are unbig, and there's lots of people, and they use the cigarettes as money, and a lot of people owe other people debt denominated in cigarettes. Like, oh yeah, I owe Jim 20 cigarettes, or whatever. And now in that environment, imagine there's a widespread, public health campaign, and a lot of people who were previously smokers realize, you know what, I either want to cut back or I'm going to go cold turkey. And so the demand for buying cigarettes drops. So I want to say, if you're asking me as an economist, what happens to that hypothetical, sort of barter system where there was a lot of debt denominated in cigarettes, if all of a sudden the demand to buy cigarettes drops, I would say, okay, well, other things equal, the market prices of a carton of cigarettes or a pack of cigarettes goes down. Ultimately, the price of tobacco goes down. Farmers end up planting less or whatever. But for somebody, a given person who owed, 100 cartons of cigarettes to my landlord or something, it becomes easier to pay that debt off because in general, the price of cigarettes has dropped. So if I owe cigarettes to somebody now, it's actually easier to pay that off. The people who held the assets, they might feel poorer, but there's no reason that the general, if the thing causing the change is not a financial crisis, but just everything was fine, and now people just, their preferences for smoking changed, and that's what the disturbance is, I would say you wouldn't expect a wave of defaults on cigarette debt. In fact, you'd expect the opposite. The default rate would be lower because in the new equilibrium, it's easier to get your hands on cigarettes because not as many people want them now. So are you okay with the analysis there, or even there you think that's not how it would play out?
I understand the analogy. In my opinion, you're missing one factor.
Okay.
And that is that in your analogy, you're equating cigarettes to kind of a consumer good rather than money. If in your analogy you're saying that cigarettes are money, in your analogy, are you saying cigarettes are money, or it's just a consumer good that people have decided to no longer purchase? Because to me, it's it makes a big difference in my opinion.
I was being agnostic on it. Why don't you?
Yeah.
Are you stipulating if they were consumer goods, it would be okay? My analysis works, but you're saying if that's the money they used, it wouldn't work?
Yes, that's what I'm saying.
Okay.
Or I think if it was a consumer good, it would be much more likely to work. Whereas with it being the currency of the realm, so to speak,
yeah,
I don't think it works. And here's why. What has happened in that scenario? Let's say I owe you 5 packs of cigarettes, right? So you are holding my debt.
Yep.
I owe it to you. But then, you might need liquidity before I give you the 5 packs of cigarettes. So a secondary market develops where you can sell those 5 packs of cigarettes for 4.95 packs of cigarettes to somebody else. So and that it's like scrip or whatever you want to call it, right? It's a second. Okay. If people stop smoking and the price of cigarettes falls, your asset also falls. It's not just the demand that's falling, the supply is falling. Because the supply, when the cigarettes are the money, if cigarettes are evaporating or becoming less, the volume of cigarettes is falling, then the volume of money is falling. And the volume of money falling is deflationary, right? If there's not enough money to go around, then prices fall. I mean, that's what a recession is when money no longer circulates, either because people are hoarding it or because the value of it's falling or whatever. If there's less money circulating, but the value of the debt is still there. Are you seeing the distinction between the money and a consumer good?
Yes.
So, in my opinion, if people stopped smoking, cigarettes would circulate in fewer supply. Like the supply of cigarettes in circulation would drop.
Yeah.
But all of the cigarettes that have been loaned into existence previous to that time period, all of that cigarette debt still exists. So in other words, let's pretend there's only 100 cigarettes. But because we loan more cigarettes into existence, there's 1,000 cigarettes loaned into existence. But there's only 100 actual of them, right, that actually exist physically. If people stop smoking less and they don't circulate as much, then it's going to be hard to service that 10,000 or a million, whatever, 1,000, 10,000, a million, whatever the total supply of cigarettes is. It's going to be harder to service that debt because the cigarettes are no longer circulating, or at least the number of cigarettes circulating has dropped. Think of it this way. Maybe I'm not explaining this correctly, but if you have $1 million of debt and you have $100,000 to service that debt, it's not so bad. But if you lose your job that pays you $100,000 and now you only have $10,000, it's much harder to service the debt on the $1 million with $10,000 than with $100,000. So in other words, if the cigarettes go from $100,000 to $10,000, but that $1 million, that million cigarettes or that $1 million debt still exists, it's harder to service that debt. And that's why I think it's a difference if it's the money or if it's just a consumer product. I don't think that there is a way, when money is loaned into existence, the only way to get around this is if the powers that be prints more cigarettes. If they were to print enough cigarettes to replace all the debt, then the cigarettes would lose value because there would be plenty of cigarettes in existence, right? Mm-hmm. So if we bring this back to the monetary system, if the Fed physically printed, let's try to keep it simple. I know we owe 30 trillion, right? Or whatever the number is. But remember, there's only 5 trillion in the monetary base. But rather than do QE, if they actually printed 30 trillion physical dollars and handed them out, then those dollars, each individual dollar would lose value and they could pay off all that debt, right? But when you're replacing debt with more debt, the demand is still there. Does that make sense?
Yes.
Okay. So I think where you and I disagree is that on a portion of the society or in a portion of the economy, I agree what you say could happen could happen. But on a systemic-wide basis, I don't think you can deleverage without the dollar going higher.
Okay. I get the distinction you're making. Let me, again, folks, this is the whole point of having Brent on here for this time. Yeah. So we're going to go through this. Let me take another pass.
No problem.
Not to say one person's right. I just want you to see.
Yeah.
Let me just spell it out a little more. And I know this is kind of silly. When we talk about cigarettes,
no.
It helps to change it.
This is why I came on here, so we can do this.
Yep. So, okay. Imagine the original. Suppose we're in an original equilibrium where the farmers are growing a certain amount of tobacco, and 1 million cigarettes are getting produced every month with this community that we're talking about. Okay,
Yep.
and there's an outstanding existing debt of various people in the community owe other people money denominated in cigarettes, such that the total debt is let's do it half and half. So 500,000. So let's say it's 5 million, and it's 10% per month, or a very high interest rate, just to keep the numbers simple. Okay, so every month, if the total face value of the debt, the principal stays the same, and imagine the people who own that as the asset just keep rolling it over, and they're just enjoying the interest. Okay, so every month, 1 million cigarettes gets physically produced. Half people go into the shops and they buy it and just smoke it for their own personal use. And then the other half gets diverted. The people acquire it, the debtors, and they get that because they owe it as interest payments on the debt they owe, right? So their principal stays the same. They're just every month like paying the finance charges on their debt is the way to think of it. Okay? And if you say, well, what's the money? You can use the cigarettes, how do the people, they're doing chores for the farmers. They're like painting their barns and watching the cattle and whatever. And that's what the services they provide in order for the farmers to hand over 1 million cigarettes every month from the tobacco, and they roll the cigarettes inside or whatever. Okay. So now I want to say, all right, that's a system that's is chugging along. If all of a sudden the people who are just every month getting, performing chores for the farmers to get cigarettes just to smoke, they don't owe any cigarettes to anybody. They just want to smoke. If now all of a sudden all those people stop doing it because, oh my gosh, it causes cancer, I had no idea. Okay, so the demand, so 500,000 a month of that demand drops. So now going forward, I want to say it's going to be easier for the people who were doing chores for the farmers to get the cigarettes to just hand over because they owed it. If anything, the fact that now the external demand, another thing that those cigarettes had to get channeled into for people just to smoke and disappear goes away. And so now I would think, if anything, it's easier for those people, as the amount of tobacco that needs to be planted, the amount of cigarettes that needs to be produced every month just to service the existing debt, it's a smaller share of the total amount. And so I would think, the land that is in cultivation for tobacco, of course, the farmers take the worst land out. And so if anything, the price of a cigarette relative to how much labor do I have to contribute to get the farmer to hand me a cigarette goes down, I would think. So there wouldn't need to be defaults. So in that little world, do you get what I'm saying? And does that make sense to you?
I do, and that makes sense as long as, and this is why, I'll tell you why I don't think it would work, but I'll tell you why it makes sense. It makes sense if the farmer continued to produce the same amount of cigarettes as they did before, even though people are no longer demanding them, which I think is unlikely. So I think the
What, can I just stop you? I picked that to say they could cut it up to half. Monthly output of cigarettes can drop to 500,000 because before 500,000 was getting smoked, so that wasn't being used for debt service. So I'm saying that accounts. The drop in the consumer demand element is what accounts for that less. So yeah, production can fall, but I'm saying it's no harder for the debtors to get cigarettes because now there's not as many people competing to get the cigarettes every month.
In that scenario, let me think. So they're still producing half the amount. So there's because the other half were getting smoked and disappearing anyway.
Yes.
So you're saying there's still the same amount of cigarettes in circulation, right?
Yes.
If the same amount of cigarettes are in circulation, then if the same amount of cigarettes are in circulation, then I would say price just stays even. If fewer cigarettes are in circulation, I would say price rises. And if more cigarettes are in circulation, then I would say price drops.
Okay. So yes, I was saying, yes, I agree with that. And if we assumed that, there were no, so that's why I was bringing in, if you wanted to make it more realistic, is they took the land that was least suitable for tobacco and shifted into tomatoes or something. And then actually, even if production gets cut in half, you'd think unit costs would be low. But okay. So if you get it there, then I'm saying the analogy now to, okay, but what does that mean for the euro dollar? I'm saying right now people are holding cash balances, right? Like there's certain dollars like in their cash possession, like, whether commercial banks abroad have some literally in the vault or
Yep.
it reserves with the Fed or whatever. And so to me, that's the analog of what if the demand to smoke cigarettes goes down, right? So the people so if the demand to hold dollars as foreigners drops somewhat, to me, that would free up some dollars that could be used for the flow of finance charges on the existing euro dollar debt. So I would think that the people who owe dollars to people, if the rest of the world in general doesn't want to hold as many dollars, wouldn't that make it easier if I'm scrambling to get dollars, if some of the people are releasing some of their holdings of it?
It would, as long as there's still enough dollars to service all of the dollar debt. But the minute there's not enough dollars, and as soon as there's not enough supply to service all the debt, then you get defaults. And defaults not only decrease demand, it dramatically decreases supply because of the leverage involved.
Okay, so
Does that make sense?
It makes
that's
sense.
That's why I think this can happen over short periods of time, and it can happen perhaps in a region, assuming the rest of the world is expanding. But again, in a debt-based monetary system, if you have a credit contraction in a debt-based monetary system, because of the inherent leverage in a debt-based monetary system, contracting supply will contract more than demand in a contraction because of the interest. In other words, if you had loans that had no interest attached, it becomes much easier to solve, because if there's no interest attached, then there can be enough money. Then there can be enough money to pay off the debt. But if the system is always growing due to the interest, again, remember, again, not just a small section of the system, but on a system-wide basis, there is never enough money to pay off the debt. I might have enough money to pay off my debts, right? You might have enough money to pay off your debts, but everybody as a whole, we do not have enough money to pay off everybody's debts, because the money just doesn't exist. There is always more debt than there is money.
Okay, I 100% understand what your argument is. Yeah. That's why I was trying with the cigarette thing. Because I thought it was easier to conceptualize. So again, I was trying to show there, whether or not you agree with this, that if the thing that's causing the monthly output of cigarettes to fall is the external demand for it, then yes, that the fact that prima facie you might look and see, oh gee, the monthly output of cigarettes went from 1 million down to 500,000. That's going to cause a squeeze, a scramble for cigarettes but no, if it happened for the reason I said, again, the people who every month had been getting 500,000 cigarettes collectively to service their cigarette debt would have no more difficulty doing it. If anything, it would be easier, I think, because they might be able to get better terms from the farmers who just saw half of their sales fall, so they might, be willing to sell the lower volume. Okay, and so likewise, I'm saying, let's put aside your interest point for a minute. I think you're even agreeing, right? If the interest rate were 0% on this outstanding euro dollar debt, then the fact that one particular holder of it decided to just let the debt mature off and then diversify it into euros or yen or something, yeah, that demand for that dollar would go down and the supply would correspondingly shrink, but the two would cancel out. I agree. The worldwide quantity of dollars broadly, M2 or whatever you want to use, would shrink. But if the thing driving that contraction was a decline in demand to hold dollars, there's no reason that for the other people who still want as many dollars as they did last week, there's no reason they would get pinched, because the supply would just be shrinking to match the reduced demand, is my claim. But now you're saying, no, there's a complication there, Bob, because of the interest fact.
That's right. And if you equate this, it gets so I'll just say, anybody who's sitting there listening to this and is confused, don't feel bad. Because this you can turn this stuff around in your head so easily.
Yeah.
But again, in a debt, this is why in a debt-based monetary system it gets so confusing, right? Because the money is lent into existence. So it isn't actually, it's kind of a figment of our imagination, right? And here's what I would say is, let's use a musical chairs analogy, right? So let's use the chairs as the supply. So let's say there's 5 chairs in the middle of a room, and that equates to $5 trillion of base money that currently exists. And then those 5 people start loaning more money into existence. And those are the people, right? And so they make with this loan, they make that loan, and pretty soon there's 100 people, or let's say there's 20 people circulating around the 5 chairs, right? And as long as the music's playing, they keep circulating, right? And there's no problem. They can trade amongst themselves. They can do whatever they want because they're just passing, promises back and forth to each other. But when the music stops, they've all got to actually get a chair, right? Now then, the euro dollar market, that is another room outside of this room. The euro dollar market doesn't even have any chairs. It's a reserveless system. If they want chairs, they got to come to the U.S. to get them. Other than the physical U.S. dollar bills that exist outside the United States, there are no chairs outside of this room. And the only entity that can create more chairs is the U.S. Treasury and the Federal Reserve. They can create more chairs. But now let's pretend we play that game for a day. And then at the end of the day, say, okay, everybody go home. Come back tomorrow at 8 o'clock tomorrow morning, we're going to play the game again. So now tomorrow we walk in, and where the chairs were, there's a curtain around the chairs. And they say, you know what, the chairs are still in there, but you can't actually see them. And now the music starts, and everybody starts circulating, right? Thing is, and the game works. It works as long as everybody believes that there's still chairs behind those curtains. The game works. In other words, you don't even really need the chairs. You don't even really need the reserves as long as everybody believes that they're there. And that's kind of what the euro dollar market is. The euro market doesn't really have any reserves, but they're just circulating around the United States because they know in the United States, that's where the chairs are. And then when the music stops, that's where they have to go to get more of them. That's why the Fed has swap lines. That's why the Fed has different programs. People can, you can deposit your treasury there. We'll give you cash. So because that's the entity that can create more chairs. And again, as long as the music is playing, it's no problem. But when the music stops, or if they say, you know what, we are no longer going to use chairs. Let's use this example. Let's say we're circulating around these curtains, and the euro dollar market is circulating outside of this room in another room. And then they come along and they say, you know what, we're changing the chairs. We're no longer going to use chairs. We're going to use bean bags, right? My belief is that in that, even if 90% of the people say, you know what, that's fine, we'll just use bean bags. My belief is that there will be at least enough people say, hold on a second. Do I want bean bags? And wait a minute, are the chairs even really in there? And I think that period of time, even though it might be a short period of time, will cause enough chaos that people will scramble for the chairs and the value of each individual chair will rise. And that's the squeeze on the dollar. So I'm not saying that a change can't happen. I'm just saying there has been so much money lent into existence that the demand for dollars is so high that in any kind of an adverse scenario or some kind of a change that not everybody's 100% on board with, there's going to be a scramble for the chairs. Now, the scramble for the chairs might cause enough chaos that they create an entirely new game and an entirely new system. And maybe gold is that system, maybe they create some new currency that's backed by oil and other commodities or whatever it is. or maybe they just come up with some new fiat currency and they've wiped out all the debt. Again, I don't know, but my belief is that in that transition, that the value of those individual chairs will rise. I think what you're saying is if the people outside the room stopped circulating, that would decrease the amount of demand for the chairs. And then if the 20 people surrounding those chairs, if that fell to 10, that takes some of the pressure off of the value of those chairs to rise. And it's my belief, I think what you are describing, and I don't want to put words in your mouth, but I think what you're describing is what Ray Dalio would call a beautiful deleveraging, where if it's done a little bit at a time, slowly by slowly, you wean the drug addict off of the heroin and just reduce the amount every day for 5 years. Eventually, they're free of the drug, and we've deleveraged, and we haven't felt any pain. And I guess what it comes down to me is that my belief is that it is not only is the beautiful deleveraging unlikely, but it's very close to impossible. Nothing is impossible. Right. I always say this, anything can happen, but this idea of a beautiful deleveraging, especially in a world which is no longer cooperating the way it was 10 or 20 years ago, I think it becomes even less likely. And I don't know if I've talked about this before. I don't know if you've come across this, but it is my belief that the Fed, the U.S., the Fed, the Treasury, not only do they have the ability, but they have the willingness to use the dollar as a weapon, monetary policy as a weapon. I think the raising of interest rates is I think that's part of why they have raised interest rates, to solidify the United States, place on top of the mountain, or however you want to describe that. Because by raising interest rates and squeezing, economies or countries economically, they can put pressure on people that is in many ways just as effective as sanctions or military action or whatever it is. Because if you put somebody in a compromised situation, but then you also provide them the lifeline to get out of it, it's, again, I don't really like the system the way it is, but I think this is the way it is.
Okay, great. And so, yeah, I totally get where you're coming from, and I appreciate all that. And just to tie what you just said back to the silly cigarette example, I agree. In that scenario, we had the original equilibrium where, there's a million produced a month, 500,000 gets diverted right into, direct consumption, and the other gets used to service debts. That if now output falls to 500,000 because the farmers just get together and say, you know what, why don't we just restrict our planting and sell fewer cigarettes and we'll raise prices, then that would cause a crunch. Definitely. Right. People would then, the debtors would have trouble because now the multiple competing uses for those cigarettes, now there's fewer cigarettes going to. Okay, exactly. So that's the distinction. So
that would be the farmers using production as a weapon, right?
Right.
Yeah.
So anyway, that was all I was trying to lay, is that it mattered to say the quantity of new cigarettes coming out of the market every month goes down. Does that mean there's a crunch or not for the cigarette denominated debt? My big point was just, it depends what caused the production. If it's because demand fell, then no, it wouldn't. But if it's because the suppliers deliberately cut back, then yeah, clearly that would cause a crunch. Is my point.
Yeah, and so I mean.
Okay.
Yeah.
So as we round up here, and by the way, folks, there's not time to get into it now. As a theoretical point, I have written at Mises.org years ago on this issue of the fact that I borrowed $1,000, but I owe $1,100 to the bank next year. There's not enough money to go around. I have written on that I think there's a way the accounting's not impossible, but that's kind of will take us afield. So as we just conclude here, Brent, I'm curious your overall view. So it's maybe it's ironic. I am not, put it this way. Suppose there's a sovereign debt crisis 2 years from now and the dollar strengthens against other major currencies. I hope people aren't going to say, Murphy, you idiot. Again, that's consistent with what I've been warning about. You know what I mean? Like that I wouldn't say, oh, geez, I didn't see that coming. I would say, yeah, I've been telling people, governments around the world are running up their debts. This is not going to end well. So just to be clear, I am not denying that possibility. All I'm saying though is, I think, for folks at home, we originally, the zero hedge debate, we had picked 2040 as the year, and then we decided that wouldn't be as provocative. Who cares? So we pulled it up. So I am very confident in saying, I think in the year 2040, the U.S. is not going to be considered the world's superpower. That and the dollar likewise will shrink in importance. How do you feel about that, Brent? Do you have a strong opinion one way or the other on that?
I think if you are right, it will be because the U.S. dollar went to an all-time high between now and then, and the whole system got reset.
Okay.
So again, the ultimate chapter of my thesis is the U.S. dollar losing global reserve currency status, either due to the fact that we have some kind of a Plaza Accord, or we have some kind of a mass conflict, or whatever it is. But ultimately, I think the dollar gets valued much, much lower because I think it will have to be. But I equally believe that the penultimate chapter is the dollar going back to its all-time high.
I think I got it now. So Brent, let me repeat this back to you, and you tell me if I've got it. So you're not saying, hey, the U.S. dollar's on top forever. There's nothing. You're not saying that. No, of course. Global empires come and go.
Absolutely.
Pound sterling used to be it. Now it's not. Okay. But your point, when somebody like Jim Rickards or me is saying that, oh, this is going to come a lot faster than a lot of people on Wall Street think, you're saying, guys, it can't be that fast, because before we get there, there's going to be an intermediate period where the dollar sharply strengthens against everything, and that's going to sort of reassert its preeminence. And am I getting that? So
that's exactly right. You got it.
Okay. All right. Okay. Well, that's good. And I guess ironically, we really are just disagreeing about the timing of these things in one sense.
That's usually what it comes down to,
and
right? Because timing's important.
And your point that you made at the opening of the zero hedge debate was the time, me being sort of a theoretical abstract economist, just teaching first principles to people, like, here's a framework that you can kind of think through these. If I'm off by the timing, I can just say, well, assume a can opener, because I'm an academic economist, whereas you advising clients with their money, timing is more critical. So anyway, that it just partly reflects.
Yeah, and, I want to say something before we wrap up here. If for anybody who didn't see the zero hedge debate, at the very beginning, I said that, I kind of started trying to figure all this stuff out for myself about a little over 15 years ago. And one of the first people I came across was you and the Austrian school. And it was absolutely fundamental in my learning the Austrian school kind of principles, first principles, and hearing you explain things from that perspective was kind of instrumental in me kind of developing a fundamental understanding of how things work, or how things could work, or economics, supply, demand, all that kind of stuff. And so, despite the fact that we may disagree here, that doesn't mean that your point of view is not important. It's actually fundamental to my understanding of how things work. So I appreciate the fact that you were on the other side, and I appreciate you inviting me on to talk about it.
Sure. So it's sort of like Batman saying to the Joker, "You created me."
There you go. We'll have to work the Batman analogy into this as well.
Yeah. Okay, well, that's a fun, lighthearted note to end on. So, folks, my guest has been Brent Johnson of Santiago Capital. Brent, thank you. This was very enjoyable, and I think at the very least we gave the viewers a crisper delineation of the different frameworks.
I hope so. Happy to do it again if you ever want to do it.
Okay, thank you. And thanks everyone for tuning in. We appreciate that you're concerned about these subtle matters. We'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.